In this video, I will discuss accounting for errors. In previous videos, we covered accounting for changes. More specifically, we learned about three kinds of accounting for changes: change in accounting principle, change in accounting estimate, and change in reporting entity. In this video, we will be talking about accounting errors. An accounting error occurs when a company recorded a transaction or transactions incorrectly. What if the error was just an accident? The company should correct the error as soon as they become aware of it. What if the company did it on purpose? Okay, well, that's fraud, and the company should still correct it immediately. What if the error is really small? Fine. So they might not need to correct a really small or immaterial error, but for the purposes of this class, we will assume everything is material unless told otherwise. When we have an accounting error, this is when we finally do a restatement. Please note that a restatement is essentially the same thing as the retrospective approach in terms of journal entry and reporting. The only difference is that we will also go to the SEC and ask for any old financial statements that included the error to be retracted. We will then correct those statements and reissue them, noting that the error has been corrected. Using our comparative financial statements that we used as examples for the accounting changes, we see that this time the company had an error in inventory in 2016 that needed to be corrected when we issued our 2017 financial statements. Because this was an error, we would also pull our 2016 financial statements back from the SEC, correct them, and then reissue them as restated. You can see an example of this in the bottom right-hand set of financial statements. When we had a restatement, our prior year numbers that we change in our current year financial statements will match our restated prior year financial statements. Remember that when we did the retrospective approach, we did not correct prior year financial statements, thus causing a disconnect between what was reported this year and what was reported last year. One special type of errors is called counterbalancing. These are errors that will correct themselves in the following reporting period if they are not detected and corrected sooner. Consider the example of an insurance contract that has a 2-year policy paid in advance. If the accountant doesn't properly understand accrual accounting, they might record this as a debit to interest expense of $20,000 and a credit to cash for $20,000. However, we know that if it's a 2-year insurance policy, the expense should be spread out over the 2 years that it covers. The correct entry, illustrated on the right-hand side of the slide, indicates that only $10,000 should be debited to insurance expense, and the other $10,000 should be debited to prepaid insurance. The credit to cash of $20,000 is correct. Let's consider the effects this has on the financial statements. In year 1, the company recorded $20,000 of expense when they should have recorded $10,000 of expense. That means that net income is understated by $10,000, or the extra amount of expense taken in year 1. At the end of year 1, the income statement will be closed out to retained earnings, and that $10,000 error will be moved over to retained earnings. So retained earnings will also be understated by $10,000 at the end of year 1. In year 2, the company will record no insurance expense, but what they should have done is record $10,000 of interest expense. That means that their year 2 net income is overstated by $10,000. At the end of year 2, when we close out our income statement accounts to retained earnings, the $10,000 overstatement to net income will be placed into a retained earnings account that is already understated by $10,000, thus canceling each other out and leaving year 2 retained earnings correct. If, at this point, we realize our mistake and went to correct it, there would be no journal entry to be made because the general ledger has corrected itself. We would still need to restate any materially misstated financial statements, but that would be an issue of reporting rather than recording. This concludes our lecture on accounting for errors. Don't forget to email any questions for our discussion.